Hello and welcome back to another episode of the Investor Financing Podcast. On today's show, we're going to talk about the ROBS plan. What is the ROBS plan? How you might be able to access some capital. We're going to dive deep in that. I think this is a good topic. I think most of us out there probably don't know what ROBS is, and there could be some untapped working capital to acquire franchises, to do your business startup. I even think you can even start a fix and flip business using it if it's done properly. So we're going to dive into because I know there's about, I don't know, everybody varies on what's in the retirement funds, but let's say there's around $28 trillion in retirement funds. Wouldn't it be cool to tap into your retirement account that's not generating any returns for you and turn it into a powerhouse? That's pretty much the conversation of today. So I'm really excited to welcome Diane, I hope I'm saying your last name correct, Rosenkrantz, or do you say Rosenkrantz?
Rosenkrantz.
Rosenkrantz, got it correct. Okay, from Tenet Financial Group. Diane has been in the pension industry, consulting, customer service area for over 25 years. She assists clients, brokers, and franchisors across the country find the best funding options for their businesses. So that's what we're really going to dive deep on today. So I guess from a high-level perspective, somebody out there has no idea what ROBS even stands for. Can you start with us there on the ROBS?
Absolutely. So this option, which is quite interesting, it's actually a debt-free option. So if anyone has pre-tax retirement funds, and there are so many options, most common people refer to it as a 401k or an IRA. But depending on where you worked or where an individual had the retirement dollars, they might have had a 403b or a 457. Maybe they had a thrift savings. Maybe it was an annuity that they bought from an IRA. Any pre-tax retirement funds, as long as they're not from a current employer, a person could use those funds penalty-free and without taking a taxable distribution for absolutely any for-profit business. And those funds become completely liquid and can be therefore used for any purchase, any expenses relating to a business, and even to pay salary.
What about it? Does a traditional Roth, can that convert over or no?
Because those funds, if they are a Roth IRA, if a person's already been taxed on them, those would not be viable. These would be only for funds that have never been taxed. So a person cannot move a Roth IRA into a regular IRA. That would be commingling funds that don't have the right type of attributes.
Got it. So it's got to be specific to what Diane was just talking about, where it could be eligible to roll. So then essentially the mechanics of a ROBS plan then is if it's a qualified retirement vehicle, it gets converted and you open a C Corp essentially, right? A business entity.
Yes.
Can you kind of walk us through the mechanics a little bit? I think this would help us.
So with regard to this, we're going to help you or a client with any and each step of this. We're going to set up a brand new C corporation in the state that they live in or the state that they want. We'll get the articles of incorporation. We'll get the federal tax ID number. We do the minutes and the bylaws for that corporation as well. Now, in addition to that corporation having its own tax ID number, we're going to set up a brand new 401k plan for that business. So therefore, the individual who had, let's say it was an IRA that they've never been taxed on, it's just sitting somewhere, and they say, wow, I want to gain access to those funds. Ultimately, that pre-tax IRA, when it's liquidated, would want to be rolled over into a new qualified plan, which would be the new 401k of their business. And when those funds are in the new 401k of their brand new for-profit business, it is enabling them to move the 401k funds directly to their corporate bank account. And how can that be done penalty-free and without taking a taxable distribution? It is the 401k that is investing in their corporation. So the 401k will have shares of stock. The company bank account will have all the liquidity and is able to then use those funds for the purchase of a brand new business, to buy an existing business, or even to recapitalize a business they have today, with the caveat that it does need to be a C corporation.
Wow, that's pretty amazing tool to take some retirement funds that maybe not be performing and turn it into like maybe the biggest performance of, if you pick the right business or right vehicle. So let's just hypothetically say that I had 200 grand. It was in an eligible vehicle to roll over to through the ROBS plan. We set up the C Corp and the 401k, the new 401k. Now the 401k is actually the buyer. They would become the buyer of, let's just say it's a franchise concept I'm buying, and it's like a QSR, a quick service restaurant type of thing. And all it takes to get open is 200 grand. So I don't need to go get additional financing or whatever. So the 401k actually owns the business. Is that accurate?
So with regard to that, it's that, let's say there was literally $201,000. So $201,000 would ultimately go into the new 401k of that business. And they therefore, in that example, need $200,000. So in this scenario, $100,000 would stay in the 401k, keep it open and active. $200,000 is wired to the corporate bank account at any bank they want. The movement of those funds enabled the 401k to own shares of stock of the corporation by the movement of that 200,000, getting the business all that liquidity. And the individual that is funding this new quick service restaurant, they personally want to show the IRS that they own some of the shares of stock. So any money that they've spent personally, maybe they had an attorney or an accountant or bought some hardware or put a deposit down, that becomes their proof that they've spent some of their own money outside of the retirement dollars. So the individual will own some shares of stock, but in the most common scenario, the 401k plan can own up to, let's say, 95% of the shares of stock of the corporation.
Okay, got it. Now, so that means it is perfectly fine for me to have co-investments, meaning like there's certain, like on a self-directed IRA, right? Like I can't invest alongside typically, into real estate or something like that with my IRA, my self-directed IRA. This is completely different. This is actually, you have more control of what the money goes for. So technically, my new other operating company can be the owner, and then I own individually 40% of the shares, and then my 401k could own 60%. Essentially, it could be any mixture of ratios.
Right. Depending on, in essence, where the funds came from. And you're absolutely right. There's so much more flexibility. This product, in addition to it being called the ROBS, which stands for Rollover as a Business Startup. And coincidentally, those initials are really quite unique for a funding product. And so it is technically a rollover as a business startup, and it is also known as a self-directed 401k, because we in fact create the new 401k of the business that enables them to fund in this manner that we're talking about. And it gives the person the ability. So not only are they the president and the secretary of their corporation, they're an employee by default automatically of that corporation. And therefore, when they want to take a paycheck from their business, they, as a W-2 employee, take a paycheck. And at that time, that's when they're also allowed to defer money pre-tax, putting it back into the 401k, growing their 401k balance. And on top of that, the person who is using this structure and having that 401k, they might want to do company match contributions. Those are optional. They might want to do profit sharing contributions. Those are optional too. So it's giving an individual many ways to grow their pre-tax retirement dollars. And as a matter of fact, the new figures and the new numbers for 2023 would allow a person who is 50 or more can defer $30,000 from their paycheck. And if they did want to do company match to the maximum and the largest profit sharing contribution, if they wanted to, they could literally put into that pre-tax account $73,000 a year starting in January.
That's pretty amazing. So let's just kind of unpack this a little bit. So this quick serve restaurant is owned 60% by my 401k, 40% by me individually. And that 60% that is owned by the 401k, that allocation of ownership would need to be paid back to the 401k. But if I'm hearing you correctly, because I'm running it, I can take a W-2 from the C Corp, and that so there's some wiggle room where I don't need that money does not necessarily need to go back into the retirement account. It can, and there's some huge tax advantages, it sounds like, but it doesn't need to be. So I can really leverage. I mean, I think people that are watching this really like, they want the money, they want the cash flow now versus later. Most of us aren't in the position where we really care about, when we're 60, 70 years old, we say, okay, well, I want to get that income now because I'm quitting my other W-2 job or whatever the scenario might be. So this is pretty interesting, the mechanics of it. Sounds like there's a lot of flexibility where, like let's just say I had a qualified plan from a previous company, but I was working at a W-2 now, and I wanted to quit the W-2 and go full time on this quick service restaurant. I could be taking a salary, and there's not any certain amount of allocation that needs to go back into my 401k, if I heard you correctly.
Almost spot on. The key is that even if a person wants to defer just 1% of their income, whether they are paid weekly, biweekly, monthly, as long as they're putting something, 1%, into the 401k plan, by no means do they need to put in more. Absolutely do not have to match or do profit sharing. Many people, as you alluded to, want to just grow the business. They want to make sure that they've got enough money liquid in the bank account for all their expenses, et cetera, and that they don't want to be concerned with taking more money out than they need to. So as long as each time they take a paycheck, they defer even a small percent going into the 401k, that's showing the IRS that 401k plan has permanency, a very important feature.
So on this ROBS plan here, these proceeds, okay, let's just say I don't have that much capital that let's say I'm starting with $100,000 that I can roll. And I'm looking at a franchise concept where, the startup cost, the all in is $900,000, right? So I'm looking at doing SBA financing. So I'm going to do an SBA 7A. So the proceeds that come from the ROBS plan is not considered a loan, I believe. This is a question. So then, because you can't have borrowed funds for your equity injection. So this is not considered borrow funds. Is that accurate?
Absolutely correct. The rollover enables the person to get literally complete liquidity. And those funds can satisfy that lender's upfront cash injection, post-close liquidity reserves, because it is absolutely not borrowed money. It is literally the funds that were invested into their corporation, completely liquid. And it is quite common that a person would use the rollover in combination with a loan that you can help them with.
That's pretty good. That's amazing, actually. So can you walk us through like a case study of like a high level case study of like a recent, something you've done in the last 12 months which was interesting, like what a client did and like what kind of business they did with it, and not specifics, just high level. So you can kind of paint the picture for people watching the capabilities of what this program offers.
Okay, so absolutely. In a couple of instances, I had gotten, let's see, one noteworthy. A bank had referred someone to me. They were working with an individual who was going to be buying an existing business, a resale. And that person, the resale was probably close to $750,000. The person absolutely needed to have some of their own cash injection and liquidity. And instead of using their own cash, the banker realized that they had qualified funds. So the banker connected them with me. That individual was able to do the rollover. There was a husband and wife. They both rolled over IRA funds. Those funds went into the 401k. When the funds were in the 401k, they were able to be then wired to the company bank account. That proved to the bank that they, as the borrower, had enough funds of their own personal so that the loan plus the rollover enabled them to sufficiently and successfully purchase that existing business. And another scenario happened to be in the food business. It was a franchise, and it was where an individual is also combining the rollover as their injection of capital with a loan. So they're working with a lender to get the lion's share of the funds, but this person had really very little liquid cash. All of their funds were in a prior employer 401k. So they were going to be able to tap into a portion of their 401k to satisfy the bank's liquidity requirement, because if they didn't do the rollover, they did not have enough cash in savings or checking to satisfy the bank. The deal would not have been feasible, but because they had an old 401k with enough funds, this made it work.
Hi, this is Beau, host of the Investor Financing Podcast. Are you a real estate investor with properties and you're trying to figure out how to refinance or grow your existing real estate business? Need some clarity and a game plan for moving forward? I'm offering a free strategy call where we dive deep on your real estate investing goals. I'll help you come up with a strategic finance plan that will help you get to where you want to go. Whether you've got a portfolio of 30 properties or you're starting out with your first property, I have a framework that has helped many investors grow. If you're interested, book a call below in the Calendly link. Now, other than your retirement not being eligible for this ROBS plan, we've talked about all the pros. What would you say that where it's not advantageous for this program to
Sure. So the rollover will only make sense if an individual wishes to tap into $50,000 or more. Based on, it's not just that one account is $50,000. A person might say, oh, I've got a 401k from a prior employer with $40,000. My partner or spouse has a IRA, that's $30,000. Well, collectively, that's $70,000. Neither one of them happened to have had $50,000 individually, but collectively the amount was sufficient. If a person is, let's say they're 30 years old and they tell you they've got $800,000 in an IRA, well, that's going to lead to the assumption, which is going to be accurate, that if they're 30 and they've got $800,000 in an IRA, that it is very likely an inherited IRA. Someone passed away. The IRS will not allow an inherited IRA to be used for the rollover. Earlier you mentioned, what if a person has Roth funds? No matter how large the Roth 401k or Roth IRA is, those would not be a fit and be possible because they are not pre-tax. One other interesting point, if a person has sufficient funds and are interested in the rollover, based upon the state that they live in and how quickly we're able to set up their corporation, the rollover on average, if there's no holidays involved, might be about 4.5 to 5 weeks from the time a person wants to start the process, and we've got all the tax ID numbers, all the plans established, custodian account, and the movement of the funds, and they are completely funded in the company bank account very often in under 5 weeks.
Wow. And in no cases, okay, so let's say I roll over, now I have my 401k, and I'm buying rental, or I'm buying a fix and flip property with these proceeds. Um, the 401k itself could be the buyer.
So in essence, it is the 401k that funds the corporation. The corporation then buys the business, the franchise, the Airbnb. And so it is the corporation became able to buy that investment vehicle because it got the funding from the 401k.
But the corporation doesn't necessarily need to be the direct buyer. There could be another operating company or holding company that the corporation owns shares of. Is that accurate?
Oh, the corporation, the individual that is doing the rollover, this would be absolutely the entity that they are an employee of the corporation. There are no LLCs or S corporations above or below it. And it is specifically as an employee of their corporation. And that corporation is then buying the business venture, business opportunity. So
if what happens if my corporation, I did the ROBS roller, my corporation, and then John Smith and I are partnering to start this franchise, would my corporation just own 50% and then he's not using a ROBS plan, he's just using his own personal funds? Can you do that? That can work like that?
Okay, absolutely. So in that regard, there are two partners. One of them did the rollover to fund the company bank account from the 401k. The other put liquid cash into the company bank account. Therefore, in that regard, the 401k plan owns shares of stock, the partner owns shares of stock, you personally with any cash you have would own shares of stock, and therefore that absolutely happens. So it is fine that another person is involved in the funding. The shares of stock would be distributed based upon the exact place and portion of where the funds originated.
And so do you actually, there's no like custodian that holds funds then? It's just your 401k plan? Is gonna,
The 401k plan, for example, would be the custodian would be a Charles Schwab. So a client's funds move into their brand new Charles Schwab 401k. That 401k in the earlier example has $201,000. They need $200,000 for the business. They leave $1,000 in the custodian 401k. They're able to defer money into that going forward. The client has full control of how they invest the money in the Schwab 401k. And they've got liquidity of the $200,000 in their company bank account. So the funds are in the client's control at all times. They have control as they are the trustee of the Schwab 401k, and they have control over their company bank account. Tenet Financial Group is a third-party administrator, and we do the record keeping, the tax reporting, participant statements, everything regarding that new qualified 401k plan.
so the custodian, with the way you guys work, can be any type of institution. It wouldn't necessarily be like a self-directed custodian. It could be an institutional like Charles Schwab, or are you just making an example there?
Almost in all 99.8%, the 401k would reside at Charles Schwab as the custodian. The client has full control, and therefore their funds never go to Tenet Financial Group, and they're in a 401k, which is going to allow them immediately upon those funds going to Schwab and clearing, they're able to be wired out so that they're in complete liquid status in the bank of their choice.
Is there a reason Charles Schwab is the main choice on these?
Well, there is no cost to set up the account at Charles Schwab. Aside from leaving $100, there's no minimum balance. And we know that they're going to be very efficient in allowing those funds to be bulk moved out of there. And we know that they're going to send this client the monthly statements of account each and every month so that proper administration and record keeping can be held.
And obviously they're a major institution with,
A discounted broker as well, or discounted entity.
yeah. Okay, got it. And then you guys as the admin of the program, there's obviously, well, one is you got to set up a C corp, so some of the fees are going to vary by state, and then you guys have a program charge, obviously. So like $4 or $5 grand to set up typically, give or take.
Yeah.
Okay, and then there's a monthly reoccurring of $120, $130.
Well, yeah, 135 is the monthly administration. It's a business expense coming out of that corporate bank account, because the 401k profit sharing plan is a full-fledged retirement account. That is whether the person is the only employee, or their husband and wife, or spouses or partners, or maybe they have other employees. When they meet the eligibility, they're able to offer the 401k plan to their employees as well. So that is a monthly cost, not per person, but for the plan.
Got it. That makes sense. Wow, this is really fascinating. This is like, like if you've got funds that have been sitting around, there's so many people you talk to, like over the years of me being a loan broker, it's like all these people have like, oh, well, yeah, I have this retirement account here, and it's like sitting there, it's not making them any returns. And that might be their 150 grand that the only thing they have really saved, right? And that could be their transition from corporate world to starting their own business. What are like the biggest food groups in this? Is it like franchises that you see people using this ROBS plan for? What's the most like? I mean, it can be so many different things. I'm just curious what the kind of 2 or 3 biggest businesses that you're seeing.
Sure. So this can, and by definition, can be for any for-profit business. It's actually been around since 1974. Yet most people probably would have had no knowledge of this. In the franchise space, as you mentioned, that it is probably the most common franchise funding option. As for other things, some people are doing this for semi-absentee businesses, whether it's for storage units or things of that nature. People are doing this for rental properties or triplexes. So as long as it is a for-profit business, people are using this in that earlier example I cited to buy an existing business. And so it just opens up the opportunity for individuals where maybe they don't have the right credit or enough cash, or they didn't have collateral. This enables them, and most people, again, didn't know that they could tap into those pre-tax funds. No matter how old or how young they are, there's no early withdrawal penalty, and it is not a taxable event. So if a person had an IRA and they didn't know about this and they needed the money, and they called up their broker and said, please cash this out. Let's say they were 55 years old. They might be losing 35 to 38% of that between taxes and penalties. With the rollover, if they want to gain access to $100,000, then it is $100,000 that moves into the new 401k, because they are investing in their for-profit business, not taking a distribution or a withdrawal.
Wow, this is really, I mean, it's pretty amazing. A lot of people don't know this is available. When I first heard about this several years ago, I was like, this is like the ultimate. If you have retirement funds that are qualified, it's like, it's like the easiest way, and you're not, if you use this for, let's just say a business acquisition or a franchise, it's like you don't have a big loan to pay back either, right? Like if you go out and get SBA or whatever, not to say I love SBA people, but you know what I'm saying? Like you could just use this 200 or 300 grand, have no debt on the business, and basically be able to cash flow a lot quicker.
It's spot on. That's exactly it, because there is no interest rate, because they're not borrowing the money. They're using their own funds. So it really is a win-win for many, many people that have pre-tax retirement funds, as long as they're not from their current employer.
Yeah, that's cool. Okay, so I think we got a good overview, everybody. I think now anybody that's got some questions, you know who you're going to reach out to, because she can answer all these questions. to see if it's a qualified account. And then, depending on the state, it's going to take anywhere from 3.5 to 5 weeks typically to get this thing set up. And then you're basically, once the funds are in there, you're ready to go on whatever business venture you want to do. Is there any accounting that needs to be done every year or different filings?
Well, each client would need to have their own accountant. Their accountant would do the filing for the C corporation, and we at Tenet would do all of the filing, record keeping, administration, discrimination testing, everything that relates to the 401k plan would be handled by Tenet Financial Group, and then their accountant would be doing their filing for their corporation.
Yeah, this is pretty amazing. I hope you guys enjoyed this episode. Diane, where's the best place people can go to get a hold of you?
People could reach out to me. My email is Diane, DIANE, at tenetfinancialgroup.com. And Tenet is spelled TENET. So Diane at tenetfinancialgroup.com. My direct number by phone or by text is 413 let's see the best number. Okay, 413-354-4662. Once again, 413-354-4662.
Very good. Well, everybody, I hope you enjoyed this episode. I always try to bring on different topics, and this is just something that we all should know about, because you never know when there's an opportunity that comes in front of you and where you're going to get the capital, or if you need some additional capital and you're getting SBA financing. This is a good complement to provide the equity injection or the reserves or the proof of liquidity. So anyways, guys, hope you enjoy this. Diane, thank you so much for your time, and we'll see everybody on the next episode.
All right. Thanks so much, Beau.
Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.